Hey everybody, Real Estate Ninja here. I hope you're doing well. We're going to talk today about New York Community Bancorp stock plunging 38%. We're looking at down the barrel of another banking crisis. And the reason why I say that is because the Federal Reserve just came out with their latest information. And one of the phrases they took out of their meeting minutes or their release was that the banking sector was strong and resilient. It's not. Okay. I warned ahead of time about the last one on the last channel, Economic Ninja. About 3 months before the banking crisis, 2 Novembers ago. And I also said that you're going to see this at the beginning of this year, mid of 2024. And it's already beginning. Okay, so let's dive right in, regardless of what happens on Monday. And that's why I wanted to do this story tomorrow. Today, even if you see things recover, these dead cat bounces, trust me, there are problems in the sector. All right. And a lot of them are stemming from, most of them, 99% of them actually, from commercial real estate mortgage collapsing. That is going to feed into real estate, regular residential mortgages as well. All right, so this story's out of the Wall Street Journal. It's entitled New York Community Bancorp Stock Plunges 38%, Reigniting Fears for Regional Banks. Before I go on, the title of the story video is Get Your Money Out of the Bank. Why? It's a click word. That's what wakes people up. That's what the algo wants to share. Do I take all my money out of the bank? No, I do not. But do I have multiple banks? Yes, I do. Do I stay under the FDIC limit of $250,000 for an individual, $500,000 per account for a married couple? I do. Okay, so I want you to understand that I'm not racing out in panic. I have multiple banks. I have lots of bank accounts actually, because I have multiple businesses and did all kinds of things I got going on. So because I'm an entrepreneur, I'm not telling you to do that, but this is to wake people up. If you have more than the FDIC limits, you've already seen the FDIC announce last year that they are completely insolvent. Please understand how big of a deal this is. All right, it says NYCB built up capital after acquiring most of the failed Signature Bank in last year's crisis. So you see, you pick up a sick bank and their assets, and some of them turn out to be cancerous, and it hurts you. It says shares of New York Community Bancorp plummeted 38% Wednesday after the company swung to a fourth quarter loss. Oh, and just so you know, sorry, this was Wednesday when it dropped a massive amount and it recovered a little bit. It was up like 5% on Friday. It swung to a fourth quarter loss and slashed its dividend to shore up capital following its purchase of the assets of the collapsed Signature Bank. So first off, when you completely slash your dividend, first off, a lot of investors are just going to bail out the window because they were holding your stock for a specific reason. That's one. Secondly, when you start telling people that in the future things aren't going to look so rosy, they're going to bail as well. And then it's just going to become this self-fulfilling prophecy. As more and more people sell, it just exacerbates the problem. All right. The company swung to a loss of $252 million or 36 cents a share at the end of December. That compared with a profit of $172 million or 30 cents a share in the same period a year earlier. This is really important to explain to people. Do you remember about 3 months ago, I was saying around November, wait to find out what fourth quarter earnings are. Fourth quarter is going to tell you two amazing things about the health of the banking industry and the entire economy at a whole, is that you're going to see how bad it was during the Black Friday time when people were spending money. That's not going to be as good as anticipated. And it's going to also encapsulate the entire year because fourth quarter being as bad as I was predicting was going to take down the entire year's numbers, okay? So we're seeing big changes in Q4 of 2023 as opposed to Q4 2022, two totally different economies. And let me tell you, this is a trend that's going to keep getting worse to the downside, meaning that 2024 is going to be even worse than 2023, meaning that when Q1 numbers come out, you're going to see those numbers worse than Q1 of 2023. Okay, and that is going to be repeated throughout the entire year. It's going to be great for the election because they're going to be able to tout all of their plans of how, they're going to fix this, and nobody's going to really pay attention to the current policies that are causing the current problems. Okay, everyone's always just wanting to look to the future. What's in the future? Well, we can actually fix things now, but things are getting really, really bad. So it said here, analysts expected earnings of 27 cents a share for the fourth quarter. So completely, totally different, right? Loan losses surged, and the bank set aside millions of dollars more to prepare for future potential losses. Just throwing out a little side note, think about one of the largest teacher pension funds in the nation, CalSTRS, the California Teachers Pension Fund, just had to take a $10 billion loan, and in their words, for the purpose, the sole purpose of not having to put out a fire sale in their commercial mortgage-backed securities. So they had to take a $10 billion loan just to sort of put some water on a fire to keep it from a bonfire level to a small fire, so that they weren't forced to sell those assets, because they can't sell those assets for anywhere near what they purchased them for, okay? Silicon Valley Bank, their CMBS loans went for around, I believe, 47 cents on the dollar. No, sorry. Was it 57 cents on the dollar? It was right around 50 cents on the dollar. Point being is they took a massive haircut. And banks like this that are purchasing these assets, these crappy assets, are now starting to go under because of it. All right? Very, very important information. Also, thank you to everybody that hits the thumbs up. I love it. Even if YouTube doesn't like it, I thank you for it. The stock fell 38% Wednesday, closing at 647, its worst day on record. When their stock falls, don't forget that if they need to capitalize or recapitalize, they have a hard time borrowing money, okay? Because their assets are worth less. As their stock falls, they have less to leverage. Okay, very important. It just gets worse and worse and worse as the stock price falls. Chief Executive Thomas Kangemi, it's an interesting name, said the company is adjusting to the regulatory demands of being a large bank after its purchase of assets and liabilities from Signature Bank. Isn't that a cute way of saying they're screwed? That's so cute. From Signature Bank, one of three banks have failed in rapid succession in early 2023 after spooked customers pulled cash en masse. With the Signature deal, oh, I must say to all my insiders, please email me if you see anything, all my banking insiders, what's going on in your banks. Let me know, because I have a feeling in the next month this is going to get real interesting. With the Signature deal, which closed last March, NYCB's total assets surpassed $100 billion, a key regulatory threshold that comes with stricter capital and liquidity standards. The bank also acquired Flagstar Bancorp in late 2022. So isn't that neat? They had no problem buying these assets, but then they did have a problem setting aside the proper amounts so that they wouldn't have issues. As part of its steps to bolster those capital and liquidity levels, the company cut its quarterly dividend to 5 cents a share from 17 cents a share. That's a big difference. That's less than a third. We took decisive actions to build capital, reinforce our balance sheet, strengthen our risk management process, and better align ourselves with relevant bank peers. The results took some investors back to the bank crisis of 2023. Weird. When Signature Valley Bank and First Republic all failed within a span of weeks. All those banks, large amounts of unsecured deposits, concentrated customer bases, and paper losses on their bond portfolios had sparked a crisis of confidence among their depositors and investors. Let me stop and say that when the FDIC walked into Silicon Valley Bank, they made an announcement that it was like 80% or 85% of the accounts that the bank had were uninsurable, meaning they did not meet the requirements of FDIC insurance. Please understand that there are a lot of banks out there that are doing the exact same thing right now. Please know that. As a matter of fact, the crisis is so bad, the FDIC told the big banks that they have to carry the burden of most of the regional banks and small banks because they physically cannot afford to pay the insurance on their deposits. How does that make you feel? Now, when this banking crisis goes full tilt, and it will go full tilt, I want you to understand, and I believe it goes full tilt at the end of 2024 and the beginning of 2025. Please, please understand that. Right after the election, you are going to see, when the winner is announced, a full-blown banking collapse. Now, when I say full-blown, I do not mean that every bank is going to go bye-bye. I do not believe that every account is going to go bye-bye, okay? I mean, it's going to be something similar to what happened in the Great Depression. Not all banks crashed. Please, please, please understand that, okay? That's why it's important to be diversified in so many things, not only just banking accounts, but in assets, stocks, bonds, gold, silver, Bitcoin, real estate. You want to be diversified amongst everything, because something like this, events like this don't only come around, and when I mean events, I'm talking opportunities, only come around once every 100 years. And when they do, it's whoever loses the least and then goes and buys up all the other assets for pennies on the dollar wins. And that's what I want for you. It says here the SPDR SPF, S&P Regional Banking ETF, and the KBW NASDAQ Regional Banking Index each fell about 6% on Wednesday, while the S&P lost 1.6%. The 10-year Treasury fell to its lowest level in weeks. Why? Because people are freaked out, so they go running and buying Treasuries, and rates drop. All right, but don't think that this is a part of a longer trend, because I believe the bond market is in very serious trouble. Not happening tomorrow, but happening in the next year, because of, you'll see. In the fourth quarter, deposits at NYCB were down 2% from the previous quarter, driven by a $1.8 billion decrease in custodial deposits related to the signature transaction. In the spring, it was deposits running out the door, said Casey Hare, an analyst at Jefferies. This was because people were pulling all their money out of the banks. M2 money supply was decreasing. It was incredible because people were starved for yield because of inflation, and they're running out and getting money market accounts. That's the simple explanation that is now alleviated a little bit because inflation, the government's telling you inflation is going down. I do not believe that at all, except for furniture and big screen TVs. I'll give them that. NYCB said more of its property loans have started to sour. Okay. What they're referring to is commercial mortgage-backed securities. Those are residential units from 5 units and up, and everything else you think of commercial, COSTCO buildings, things like that. Oh, everything else. So it's getting worse. So you see, it's getting worse. Please know this is what I've been warning about. The magnitude of credit loss is an open question, Hare said. Net charge-offs surged to $185 million from $1 million a year earlier, driven by 2 loans in the space. One was an office loan that had gone bad after updated valuation in the third quarter. Oh, this is going to be really good to explain. The other was a co-op loan that wasn't in default, but the bank expects to sell in the first quarter. So let me explain how this happens. It's so easy. It always starts with just one loan. Just one loan. One loan goes bad. It's not even that big of a loan. But when the banks are running such tight margins, they're paying their FDIC insurance, they're doing all this stuff. Money comes in the door, money goes out the door, even on an overnight basis. One loan goes bad. That changes the entire dynamic. And that loan going bad, gone unchecked for 30 days, 60, maybe even 90 days, disrupts the entire balance of the bank's balance sheet. And then what it does is another one fails, and then another one. It always starts with one. It always starts with one. I was the first person on the entire darn internet that warned of the commercial mortgage-backed securities crisis when I first started the channel. Matter of fact, that's what took the channel, the Economic Ninja channel, to super heights, because Google ranked my video because I didn't, and I've got that video ready to go, timestamped. There'll be days when it comes out, because people need to know that all your fancy people on the internet or on CNBC watch channels like mine. I'm not joking. I do know this for sure. And because it ranked in Google, it got a lot of attention from very powerful people. And you see people like Grant Cardone now all of a sudden come out and say, this is gonna be the worst crash ever, even though mere 6 months ago, he was saying you're a moron pretty much if you don't have $1 million in the bank and you're not invested in real estate. Now, because his business is crashing and that's will piss him off and he'll just want to sue me because that's how these guys work, rather than just going, hey, dude, you nailed it. They want to buy a ton of advertising, sell a bunch of stuff to you, and give you pennies on the dollar for your investments. That's just the truth. That's just it. I'm okay being the little guy. This world is made more up of people that get attention based on how much money they spend to get in front of you and how much they can sell you. I'm trying to wake people up ahead of time to position themselves for the greatest real estate crash ever. I just can't stop trying to share all this information. But the fact of the matter is, you got to have skin in the game. I put that discount link down to the real estate, how to prepare for the real estate crash course if you want. I'm still moving on, and I've got amazing students in our group coaching calls start at the end of this month. start taking a certain type of investor to that next level. But the fact of the matter is, these banks are crashing, and the crash is gonna get worse. So what are you gonna do to get ready? Are you gonna identify the problem and do something about it? Or are you gonna sit on the sidelines like 2008 and let it happen to you? I hope the latter, because, or I mean the one I said before, because quite frankly, there's a lot of opportunity here, and we're gonna lose our country if the banks get bigger by taking your home through a foreclosure. So we need 1 million people to get ready for this, to buy multiple homes during this crash, to not be scared, but be prepared. Hope you got something out of this. The Real Estate Ninja is out.